astra.org.au.
Welcome back to Money Exchange. Traders have been speculating about when the Bank of England and the US Federal Reserve will raise their official interest rates for more than 12 months. Neither of them have moved in 2015, and with recent stock market volatility and concerns around the global macro positions, central banks have now been potentially pushing back their expectations of raising interest rates. As a currency trader, it's interest rates that move currency values in big trends. And joining me from London to chat about the latest currency trends is global macro strategist at Aviva Investors, Marc Seeman. Marc, the Bank of England decided to leave its official cash rate on hold again Thursday. The pound's experienced a stellar rise in the past couple of years. Should we expect to continue to see upward pressure on the pound as the Bank of England inches towards lifting the official cash rate from 0.5%?
Good evening, Andrew. Thank you for having me. It's a good question. We're waiting for this from the Fed and the Bank of England so far this year. I still expect the Bank of England to move early next year, let's say around Q2. The UK economy is still robust. The housing sector is still healthy. Real disposable income is growing. And most importantly, to my view, the Eurozone domestic demand is picking up. This is the UK's major trade partner. So this is positive and supportive for the external sector for the UK. Now the problem is the CPI, the inflation, headline inflation, which was flat in August. But if you look at the decomposition of the CPI, services CPI is growing at 2%. Nominal wage growth is at above 3%, which is reflecting the strength of the domestic demand and some domestic inflation pressure building up in the economy. The external factors, international factors like energy are dumping the headline inflation lower. And I don't believe the Bank of England can control these external factors. So at some point, the MPC will focus on domestic factors, domestic outlook for inflation, and move early next year, earlier than what the market is pricing and expecting.
Okay, let's move over to Europe for a moment, Marc. And the European economic data continues to disappoint. A lot of people are expecting stimulus from Mario Draghi between now and the end of the year. Is the euro got that potential stimulus already priced in, or is now potentially a good shorting opportunity for currency traders, do you think?
To be honest, I see the Eurozone starting to benefit from the QE program so far. If you look at macro fundamentals, economic fundamentals are cyclically improving. The money supply, real money supply, is growing above 10-11%, which is constructive. PMI is at 53.6 for the Eurozone, consistent with a 2% growth. And even France PMI is above 50, which is constructive. Now, the problem and the challenging question is on inflation. The drag on inflation is coming from energy and food prices. The consensus is for the ECB to act and extend its QE program. However, I don't believe Draghi will commit from now. We still have 11 months to go in this current program. So overall, the market is driving the euro in sideways between 105 and 115. I don't see any trigger to drive the euro much higher. The ECB will keep it low, as low as it can, but much lower. Below 1.5 is not reasonable in my mind. With a huge current account surplus at 2.5% of GDP, the euro might be trading sideways.
What about down under here in Australia and New Zealand, Marc? What are your thoughts on the Aussie dollar and the Kiwi dollar? Are they still a little bit overvalued?
They are. If you look at the real effective exchange rate, despite the huge or the significant adjustment we saw so far, they are still expensive. At least I can say they are not cheap yet to attract capital inflows or FDIs or foreign direct investments into the countries. So the weakness is driven by the terms of trade shock, the capex cuts, which is an income shock to the economy. The housing sector, the household sector is robust. However, the manufacturing sector is very small and cannot offset the weakness coming from the mining sector. So the linkage to the slowdown in China, the linkage to the weak commodities will have additional pressures on both currencies, both dollars.
And talking about China, Marc, do we anticipate between now and the end of the year, or potentially in early next year, that the People's Bank of China might meddle with that currency peg again?
I'm less concerned about this risk compared to a couple of weeks ago, and the main reason is the intervention, the sharp intervention from the PBOC in the offshore market to close the gap between the CNH and CNY. And to my mind, this is a huge signal to the market, managing expectations and telling us they are more than happy to keep the currency stable going forward. What has changed, Andrew, in my mind, is the shift from the old fixing mechanism to the new fixing mechanism, giving the central bank more flexibility to depreciate the currency on a gradual basis rather than a sharp decline. So they can do a gradual depreciation over the next 12, 18 months without making headlines or risk headlines. So I'm not expecting a sharp depreciation in the next 3 or 6 months. If a gradual depreciation is both needed and desirable, and this is what we might see going forward.
Okay, so Marc, lots of major currencies for you to focus on throughout the world every day, every week, every month. Give us your thoughts on your top single one currency that you think is going to likely move more than anything else over the next 6 months. Is there one?
I'm going to create one basket instead of one name. EM Asia FX is a spot. Vulnerable currencies, they are still expensive, facing deflation. Monetary policy is still easy, and they have to cut rates or talk down the currencies. If Japan, let's say, will extend its QE in October, end of October, you have some pressures on some Asian economies to depreciate their currencies to remain competitive in this weak global demand environment. So the EMFX Asia is something we should focus on the downside. EM currencies in general are weak. They moved a lot in the last 12 months. We can see pocket of values. However, I'm not seeing any trigger right now to see an EM rally. Fundamentals are weak, so we are focusing on the Fed hike right now. And maybe once the Fed hike will be behind the scenes or behind us, we will start focusing on macro fundamentals between countries and currencies. But the weakness might focus on EM Asia now. FX Asia.
Thanks very much, Marc. We really appreciate your time today.
Thank you for having me. Thank you.
After the break, I'm going to be sharing with you my big currency movers and give you a chance to win $500 cash. Don't go away.